Hi there, I'm Tyler Ballhorn, and this is the Stockscores Market Minutes for December 9th, 2013. This week, I want to talk about a common cliche that just about every trader has already heard, and that is stop losses and let profits run. Although it's a cliche, the question is it really that important? Well, to drive home just how important it is, I want to show you an example with two traders, each taking the same entries and having the same success rate, but each with different exit strategies. Trader A does the trades that you see on the left, and Trader B does the trades that you see on the right. And they're pretty much the same until you look at trades 3, 4, 5, 7, and 10. On the Trader A side, you can see that there is never a loss bigger than $200. This trader obviously had a stop loss limit of $200 on his or her trades. Trader B didn't use that same stop loss strategy and incurred larger losses, a $300 loss on trade 3, a $700 loss on trade 4, and a $500 loss on trade 7. Meanwhile, Trader B also was quick to take profits. This trader didn't capture the $1,200 gain on trade 10 because he or she sold that trade too early, locking in a $200 profit and probably patting himself on the back saying, hey, that's a profitable trade. You never go broke making profits. We've all heard that silly saying. You also see that trade number 5, where there was an $800 gain for Trader A, there was a smaller $300 gain for Trader B. Well, the result then is that while each trader was right 70% of the time, Trader A never took a loss greater than $200 on the weak trades, while Trader B had a $500 and $700 loss. Trader A was patient with the winners, allowing for $800 and $1,200 profits on individual trades. Trader B sold these same trades early for $300 and $200 profits. Now, virtually all of the other trades were the same. In the end, Trader A made $2,400 by stopping losses small and letting profits run. Trader B broke even on the same trades because of a poor execution and not following the old saying, stop losses, let profits run. Now, at this point, you're probably saying, well, Trader B is just silly, but I will tell you that most traders are more like Trader B than Trader A. They don't stop their losses. They hang on, hoping for turnarounds. And when they have winners, they are quick to take profits at the first sign of weakness. All right, let's get into this week's market analysis. This week, rather than look at long-term charts, which we've been looking at for a number of weeks in a row, I am looking at intraday 30-minute charts going back 1 month to give you the shorter-term view of the market because we have seen a fair bit of short-term turmoil over the last couple of weeks. Here's a chart of the S&P 500, which bounced back very nicely on Friday and continued those gains into today, but got stuck at the resistance level on the chart. And it appears likely to me that in the next few days, the S&P 500 will probably fall back lower and basically trend sideways over the next few days. We have support at the green line, which is a rising bottom line of support, and we have resistance at the red line. Now, if that line of resistance is broken, then the upward channel will likely continue, but I don't think that's what will probably happen. So look for a neutral market with a downside bias in the very short term, but in the medium term being out more than a week, we're probably sideways. The Toronto Stock Exchange has been in an upward trend for a few weeks, but in the more recent history, in the last 4 or 5 days, we've seen a downward sloping channel. And until we break the downward trend line, the top red line that you see on the chart, I'd be a little bit cautious with Canadian stocks because I do think that there is some potential for short-term profit taking after some pretty decent gains over the last few weeks. Now, if that downward trend line is broken tomorrow, then we can sort of expect that the market will move back to the highs at 1960 on the ETF. So that's kind of what you want to watch for, a break of the downward trend line, but more than likely this market stays in that very short-term downward sloping channel. The treasuries have broken a little bit of a downward trend line that has been building for the last 2 weeks, And it looks to me like treasuries may hold support at that 102.25 on the ETF there and move back up towards 105 on this ETF. Now, of course, remember, as prices go up in bonds, yields go down, so that would be a bit of a interest rate break, but big picture, this is still a bearish chart with this market likely to go down, which means interest rates likely to go up. I just think in the short term, we're probably trending sideways as we sort of work through that 101.50, or pardon me, 102.25 to $105 trading range on the ETF. China had a big jump a couple of weeks ago and has been in a sideways trading range ever since. This is a market where you're sort of looking at a parking lot, not a lot of action in this market, but it's stability building, and that is a positive. If we can break through resistance, then expect to move higher. If we break through support at the green line, expect a move lower. Here's a chart of the emerging markets, a little better in that it has broken its downward trend line, but upside is relatively minimal. I think you see resistance there at about $43 on the EEM ETF. Given the gains of the last 4 days, I think you may see this chart fall back into its channel, but it's slowly building some optimism, and it's likely that we're more or less sideways with a bit of an upward bias in the days to come. US dollar is in a downward sloping channel at the bottom of that channel, which means it's a bit oversold, but nonetheless, the bears are in control, at least in the very short-term 2-week time frame that we're looking at here. I think that you'll see a little bit of a bounce back in the near term, like tomorrow, the next couple of days, but the bias is generally downward, and so you want to be bearish on the US dollar relative to global currencies. Gold is getting a little bit of a lift from the weakness in the US dollar. It's broken its short-term downward trend line. Now, we shouldn't confuse this downward trend line with the longer-term downward trend line on gold, which has had me bearish for some time, but it is a positive sign for gold. You can see I've highlighted the rising bottoms there, and my expectation is we'll see a little bit of a upward move in gold in the short term, but I'm not too optimistic beyond that. Oil had a real good bounce back over the last 2 weeks, pretty much as we called it, bouncing off of support on the daily chart. That bounce is in, and we're now probably at the top of where that bounce is likely to hold. I think that with that downward bias there, and after the recent gains of the last 2 weeks, wouldn't be surprised if we see a little bit of a pullback in oil in the short term. My big picture outlook remains neutral, but short term I think we could see a little bit of profit taking. Fear took a little bit of a jump higher as December started, but that all ended late last week, and as I've said many times over the last year, fear is not a factor in this market. So I've in brackets put my short-term rating in addition to my longer-term rating. US stocks longer-term bullish, short-term neutral. Canadian longer-term bullish, short-term bearish. I think we could see some profit taking in the near term. Gold long-term bearish, but short-term I think there's a little bit of a bounce back underway, and that's a bullish outlook for the next few days to a couple of weeks. Oil neutral, and neutral on the shorter-term time frame, although a little bit overbought in the very short term right now. Long-term outlook has not changed, but in the short term, US stocks are likely to trend sideways. Canadian stocks should see some profit taking. Gold may rebound, and oil may stall after the recent run up. Well, that has been the Stockscores Market Minutes for December 9th, 2013. Have a great week in the market and trade well.